So if you've been asking yourself, where's my next 100% gain coming from? Looking for a stock that could double in the next 5 years, 15% a year, I may have something for you, so stay tuned. We are looking at Inmode, who recently released their full year 2021 results. We'll have a look at what that means and why I think potentially they could be undervalued. But we'll start with the usual disclaimer, this isn't financial advice, so make sure you do your own research before acting. If you have a look at Inmode, they're quite cool actually, some of the stuff that they do. If you have a look on screen here, they've got some pretty cool high-tech devices, and it's all kind of in the medical devices sector, and they're looking to produce minimally invasive solutions to avoid larger surgeries, more costly surgeries. That's Inmode in a nutshell what they do. Trade at the US stock exchange, the current price is $47 a share. We're going to have a look at the latest results that they've released and then go into a bit of valuation. Stick around for that. So the conference call of their transcripts, I've just highlighted the key things here that I think we need to look at. So first of all, it looks like a record set of results. So their Q4 fiscal year 21, which then takes us to the full year, $110 million, 357 for the full year. So that's really impressive in terms of the increase over the previous periods, very large percentage increases. And they're now looking at being a $100 million quarterly business. So they are growing pretty well. So that's the first tick in the box. Now, secondly, the net income, which is very important. We're looking at over $50 million here. If you can compare that to the revenue, there's a very high profit margin. 165 million for the full year against the 357 million of revenue. Very high margin business. And in terms of what they're selling to generate that revenue, you see 89% of that is kind of what you might call capex, or actual, the machines, for example, that we looked at before. There's an increasing proportion of consumables, which would mean that as they sell more and more of these machines and devices, they'll actually be able to then increase that turnover and the scope for those consumables. I think it's really good to see that they're focusing on improving that now as well. Yeah, so finally on this page, it's also worth noting they are starting to expand their Italian operation, and they were actually already are in 71 countries. So that a lot of that risk of expanding to new territories, they've already dealt with that because they're in 71 countries. They've got bases in lots of markets. So again, I think this de-risks the company in terms of diversification of their income streams. So it sounds really positive already. Now, the interesting thing here is the virus, of course, and what impact that's been having. Now, they return these really strong results with some of the virus circulating, but they don't seem particularly detailed here. They hope the current wave passes and it'll be the last one. I'm not sure whether that's realistic. Perhaps no one really knows the answer to that, but it feels quite sort of flaky around hope rather than detailing what their plan is in order to deal with what would happen if there are new variants. On the next page here, the US is the largest market and is growing rapidly. And we know that healthcare in the US can kind of deliver a high premium. So it's great to see that that demand is still growing substantially in that market. Looking at the earnings in more detail, we saw that figure earlier. Per share, we're looking at around about for the full year, $2 per share. So your kind of sense check here for me is price is 47, earnings is 2. So you're probably looking at something like a PE of 23, 24 on that basis, which is certainly higher than the average. But if we have a look at what it is for the industry, there is quite a difference. And in fact, you can see here, Simply Wall Street is quite helpful. It tells us the answer. The US medical equipment industry average is 46. It's trading at half the industry PE. So again, this suggests there might be some value here. A couple of other things to call out here. Now, the market cap's around 4 billion, but they've got cash equivalents of just over 400 million. So 10% of the market cap of the company is actually effectively in cash. And they actually generate 175 million of operating cash flow, which is a pretty big number. So it looks like very fast growing revenue, profitable, loads of cash on hand. So I think that's really important on the basis that it feels like they're unlikely to fail, which is one of the big risks removed. They've got that income diversification and they've got really high margins. So this sounds like a really strong story here. Now, they are having challenges, just as many businesses are with logistics and supply chain. And perhaps the disadvantage of operating in so many markets is that effect may be amplified. They've said that supply chain situation is getting worse, but they have actually done well to manage it in the past year. Yeah, shipping costs are up, but many companies are in that situation, and it may well dent their earnings in the next quarter, but then that could potentially provide a buying opportunity. But just finally, on the kind of earnings transcript, they're looking still at very high margins, which is great, but they are going to start paying some taxes, so that will eat into the overall returns available for the shareholders. But speaking of shareholders, they have actually started buying back shares, which is great, and they've got permission to continue to do so. Again, generating value here, and they are looking for M&A, but it feels like they're being quite careful around how they're doing that. And then looks like for the next couple of years at least, the sort of organic growth or natural growth, as they have been doing, is going to continue. So we're in for at least 2 more really good years by the looks of it. The company's giving us some info there, but let's have a look at how they've been doing, because historically, they keep beating earnings by quite decent amounts. They constantly over-deliver around what they say they're going to do, and it feels like, as in their transcript, they're quite conservative, they've said, in terms of how they assess these things. There's not much analyst coverage yet, just 4 on Yahoo. Perhaps Wall Street doesn't know about this company yet, so it's a good opportunity perhaps to get in before Wall Street does. And have a quick look at their full history, and you see the revenue has been growing very well to 358 million. The operating margin very, very high. Net income's always there. It's the free cash flow, which we'll need later on, is 174 million. There's basically no capex, which again is great. So they're growing fast, but the capex they're using is very, very low. Let me have a look down here. The margins are high 40s%. Return on equity, very, very high consistently. Current ratio is absolutely massive, so they can certainly pay the bills. And debt to equity is basically 0. And again, you can see this on Simply Wall Street, another good source of information. The revenue bar and the way this is broken down, massive, massive earnings here, really impressive margins. It's a pretty flawless looking balance sheet here. It's all green. That debt to equity is beautiful, so it's a fantastic business. Now, growth is slowing, however, perhaps as you'd expect as businesses mature. We're looking at 55% a year for the past 5 years, according to their calculations. It's been a lovely trend. Now, going forward, 10% is suggested here on Simply Wall Street, which I think is a bit of an underestimate, going from 165 million up to getting towards 200 million. It should be a forward PE of probably around about 21, something like that. If we flick over to the Yahoo page, we're looking at 33% a year for the next 5 years. So we've got 2 quite different figures. So as I project forward, perhaps I use the middle ground of 20%, which certainly seems feasible based on the growth they're seeing, additional kind of consumables they're starting to sell, and the quality of their product. So I'm going to drop over to the discounted cash flow calculator. You can use it's a profitable company with some established trends, so we can use this. So I'm going to simulate for 5 years and a discount rate of 15%. Discount rate of 15% is what I'm trying to aim for, and that is the business therefore should double in 5 years. That's the rate of return that I'd like. I want to have a terminal multiple there of 25, which is effectively saying the PE in 5 years' time will be 25. Probably where they are now, and it is certainly much lower than the average for this industry. We've got a market cap in there of 4.3 billion. You could argue we should use the enterprise value because they've got lots of cash and no debt. Price is 47 with 83 million shares outstanding, and we've got starting free cash of 174. And the growth rates that I've used 20% a year for 3 years, and then 15% a year for 2 years, because it's likely to start slowing at that point. The 20% is in between the analyst estimates, where Yahoo's got 33% for 5 years, and Simply Wall Street's got a lower value. They've got that cash pile, so they're either going to do share buybacks or they're going to buy another business to accelerate their growth. And they've certainly been growing very well and using their kind of resources wisely so far. This feels like a reasonable assumption of their future growth. Free cash flow is a bit of a sense check, go from that 174 million, and it would be 400 million in 5 years' time, which that feels like that could be possible. So that gives, for me, therefore, an intrinsic value per share of $73 per share. So that means that at 73, the price today was at $73, it would be fairly priced, according to my personal calculations, double in 5 years, which is the dream, really. But actually, there's a 50% upside on the current price to get to that. So that suggests there is a margin of safety to get to that return. Now, perhaps you might say, oh, actually, maybe P 25 in 5 years' time is a bit optimistic. Maybe it'll be 20. Even if it's 20, price of 61 would be fair today, and that's upside to that is 31%. So again, there is a margin of safety built in. I don't think you need a huge margin of safety with this one compared to some. There's no risk in terms of the revenue because it's in so many different countries. Kind of the stuff that they do is very unlikely to no longer be relevant. There's no debt. They're growing well. They've got huge margins and cash flows. So this company is so strong that perhaps you don't need as big a margin of safety as you might do in some of the other ones. It's always good to do a bit of a sense check and a spot check. So Simply Wall Street has a bit of a sniff test here, gives a fair value of $71 a share. So that's broadly in line with the numbers that I've come to there. Now I've got them in my portfolios. We've seen here, I've opened a very small position. When I originally bought it, I had very little cash, and then the price went up so fast that it was no longer undervalued by a substantial margin. So my position size is pretty small at the moment. I'd like it to be a lot bigger. But that's just what I think. Let me know what you think in the comments below. Love to hear your opinion on this company. So that wraps it up. And stay tuned for my next video because I have a very exciting announcement about the channel. See how Inmode fits into my portfolio today. Click on screen now and you'll see my full portfolio breakdown.